Thank you so much, Marty, and welcome everybody. Today is the real estate and hard assets. We're going on until just a little bit after 4 o'clock. We appreciate everybody joining. We've got a really good group today. We all spoke earlier in the week to make sure that we really understood our disciplines and what everybody was going to be doing. Real estate, as we all know, is the backbone of every family office. It's the largest asset allocation they have, and it's a legacy asset. Usually you're seeing full market cycles of 7 to 10 years on a minimum hold, and you might see G2, G3, G4 hold for assets in terms of growth. So I'm going to make some quick introductions, then go back and talk to each one of our panelists, and we've got a lot of great Q&A that the four of us have assembled. I'd like to introduce Jeff Lehrman. Jeff is a lawyer. He represents Lehrman Law Partners. Jeff and I believe that he thinks as himself and his firm as the real estate investor's lawyer. And it's so true when you really start to hear about who he is and what he does. He's also a real estate investor. So I think that brings a lot of credibility to the table. And he's a principal in a single family office. Joint ventures, syndications, transactions, and litigations is really an area that Jeff excels in. Jan Galvanoni is joining us. He's a chairman of Dbg Investments, lives in Arizona and Southern Cal. He runs a dual family office. And in doing so, you're going to hear today how eclectic his portfolio is. And his group has put together a little bit more than $2 billion in assets into the ground over the last 18 years. And he put his company together in 2004. Paula Argento, also a lawyer, is joining us today out of Las Vegas, Nevada. She's the managing director of her firm, Argento Global LLC, corporate advisory, special servicing, multifamily, and a very good niche in hospitality. And then rounding out our group, as you can see there in the podium, is Scott Oakland. He's the managing director of institutional relations at Registar Property Company. You heard from the owner and chairman this morning talk about their interest in Texas and how they were put together. I think what's interesting is that they own and operate a little over 13 million square feet of real estate across 13 different states and 35 cities. So Jeff, I'm going to kick it off with you because I think some of the things that you do is just really interesting. And I'd love to learn more, and I think the group would too, about construction agreements. I mean, how does a family office who might have limited personnel and people behind them and advisors protect themselves to make sure that their project gets done, completed, and on time and on budget? Talk about that for a minute, if you would.
It's a timely topic as we head into the fall, because people already have been doing construction, and there are also people who are about to try to get something done before the fall hits and before winter, and even during those seasons, there's issues that have to be fixed with new construction, and so it is very timely. It's astonishing to me how often we do transactions and litigation. So it's astonishing to me how often somebody comes to us with a litigation problem because their project is over budget or it is late, sometimes years late. And people who can enter into that kind of a contract, and here I am in Marin County, so if the people are local, then they're usually paying, they're committing themselves to sometimes millions of dollars without having a lawyer look at it. And so the best thing that you can do if you're the property owner is to make sure that you don't just sign whatever contract the contractor gives you. Nothing, not trying to say anything about contractors, but I can tell you that I have seen a lot of really bad contracts that contractors give to their clients. And so it's really important for you, if you're going to sign a construction agreement, to make sure that you are working with a lawyer who has done that before, has expertise in that area. Even the courts say there's so many disputes that arise in the construction process that it would be foolish for anybody to go ahead and sign a contract without expecting that there's going to be a problem. It's that common, and it's right. We've all, anybody who's been through construction understands exactly what I'm talking about.
Right. I think you have one of the most important seats at the table, being an outsourced, lawyer, outsourced real estate guy. to a family office. And I can see how, vital your role is to a family office. So thank you for that. Let me go to.
And by the way, on this point, if anybody wants, I have a webinar that I'm happy to send for free to anybody who wants, as far as where I talk about this topic in a lot more detail. So happy to offer that up to anybody.
That's really nice. And I think that Marty would appreciate that. Dan, you're the head of Dbg Investments. Again, I talked about $2 billion in investments over 18 years. Now, you're a dual family office. And when you and I spoke earlier, you told me about your father was in commercial real estate. You watched him purchase real estate, Jack in the Boxes, golf courses, ice skating rinks. I mean, that had a real impression upon you in going into real estate. And you told me that in 2010, you didn't make money or lose money. How did you manage that?
So I'm a fairly young guy, and my father and I have both been allocators in real estate, and he made his money in technology. And can you hear me?
Absolutely.
Yes.
Yeah. And he made his money in technology. He was behind the barcode reader. My family controlled 90% of that market. Then I made my money in capital markets. So, in 2010, I was about 20, probably 29, 30 years old, and we were pretty thin, and we were getting choked out of the market by a bunch of regional players who had the best staffs and all the investors. I mean, we were a fairly young firm, and we were mostly losing money in venture capital, as I say. And then we said, let's get into hard assets. And over the last 11 years, we've deployed, 1.6 billion, 70% into real estate and 30% of that into special situations, stuff like subprime auto loans. In real estate, what I learned from my father as an investor is you really got to bet on good operating partners. We don't have, we have a good management team, but we don't have 30-year track records in anything outside of allocating and raising capital. So we had to build a network, which has taken a long time, of, guys who are strong in multifamily in different markets, hospitality, mixed use. And it's allowed us, we've done some of the bigger deals in the country. We did the $2.5 billion deal in downtown Nashville. We put up 100 million. So we've been able to insert ourselves where we've done lower middle market deals as a family office, but then we've wrote and put together very large checks where we more interface like a private equity firm to the market.
Amazing. Yeah, I think, watching your father put real estate deals together really had an impression upon you. And I have a lot more questions for you. So let me just move on to Paula. Paula, welcome. Thank you for coming in today. Yeah. Paula resides in Las Vegas, Nevada. As I said, Paula's the managing director of her firm, Argento Global. You have a real niche in hospitality and multifamily real estate investment. And you also work with a firm called the Conrad Family Office based out of London. So being their representative here in the US and running your own firm, tell us a little bit about hospitality. We'll come back to multifamily, but what are you seeing in the hospitality market today? Because we know that they're getting beaten up very badly due to COVID.
It's very interesting you say that, Matthew, because in certain respects, it really depends on which market we're talking about. For example, I'm on the advisory board for Luxury Hotel Advisors out of Newport Beach, very experienced fellows and gals that hark from Rosewood. One of them, in fact, managed the Hotel Bel Air for about 12 years for the Sultan of Brunei, if I'm pronouncing it properly.
Correct. Yep.
They built the Hotel California up in Santa Barbara, which, by the way, on the 4th of July had rooms for about $900 each. So they're doing very, very well. So it depends on the market that you're in. Now, we're looking right now for properties on Miami Beach for an Asian investor. We're looking, our sweet spot is somewhere in the neighborhood of 250 to 300 rooms for this particular investor. We come in and we advise on acquisition. We advise on repositioning. We'll take a look at the competitive set in the market, also the market drivers, all of those good things, and advise on how to reposition a property. We also advise on selection of managers. We typically advise on an independent hotel, luxury hotel, because we think it brings more to the bottom line. Nothing against a good franchise, but that's really our sweet spot.
Let me change the subject on you. Let's just stay with hospitality for a second. Do you see a lot of repurposing? Do you see a lot of Ramada Inns? Do you see a lot of small hotel chains or the bigger ones actually repurposing into maybe apartment buildings or long-term stay?
Well, yes, in fact, we've had a number of discussions about that, not with my luxury hotel advisory group, but hotel forums in general. We've been all talking about maybe changing something into a multifamily, or repurposing it into some sort of office. And I know office is out of favor too in some places.
Correct.
but I'm also familiar with an investment fund that specializes in Midwest gateway market office investment, and they've been doing really well. In fact, they said that over the course of COVID, they've had 98% revenue coming in, and that really the only people that were taking a hit were, say, the cafes and the breakfast shops that couldn't open.
Well, I
because
think
there wasn't anybody to sell to.
and I'm very glad that you brought up the idea of the gateway cities. That's something we're definitely going to circle back to. So, Scott, let me just ask you a question. I know that you're one of the managing directors in institutional relations for, and I'm going to absolutely blow the name, Registar Property Company. So, because you're technology enabled, and because you do private equity, and you do accredited investors, and you're looking for people to put into your fund, which has minimums of $2 million on up. Tell us, some of the areas that you're looking at. Again, gateway cities, what are you looking at in terms of the states that you put into your fund?
So first of all, thank you, Marty, for hosting a great event. Matthew, FYI, it's Rastegar Property Company. And my last name is Olguin, like Seguin. So a little house cleaning there. Thank you so much. First of all, I just want to thank all the other moderators or speakers. This is incredibly helpful as far as the knowledge level. I can tell you right now, my strength is out fundraising, being the conduit for Rastegar out in mainly the public funds arena, mainly firefighters and police pension funds throughout the country. The professionals at the back office, they go out and select and have done a great job of sourcing real estate over the past. So when it comes down to as far as these different markets, I think early on you hit the nail on the head, and that is the specialists in these different regions or hospitality area, et cetera. That when a family office is deploying assets, I think that's a key thing to keep in mind. Is go
to my question. My question for you was gateway. What is your gateway cities that you're going into for your fund? What are the gateways?
Thank you, Matthew. I apologize. Our gateways are real simple. The lower 15 states, Sunbelt states. We're going where the jobs are.
Okay. And then you and I spoke earlier, and you told me a little bit about, the Carolinas, Texas, and Florida. Talk about the Carolinas. We don't hear a lot of people going into the Carolinas. And which cities specifically are you going into?
Well, so initially on our fund, we're rolling out. We get asked that question quite a bit. The lower 15 states are our target area, but quite honestly, we'd be foolish if we didn't start in the Texas Triangle. So that's where we're deploying most of our time and our effort right now at this time.
Okay, so we'll come back to the Carolinas. So Jeff, let's just talk a little bit more about, where I see, you having such an important seat at the table. I want to talk about commercial leases. I want to talk about, commercial tenants. Retail is getting slammed. Office is just having a tough time keeping their tenants in. If I'm a big law firm and I've got deep pockets, I'm not paying you. And then I've got moratoriums coming in based on, me holding a piece of property, and the government says because of COVID, I don't have to pay you right now. So tell us, how do we protect a family office who makes an investment into an office building, but now he's not getting cash flow?
Well, so that is obviously a very common problem for people for the last 19 months. We've been dealing a lot of these issues in the context of office and retail. And so as a matter of fact, we have a guide that we prepared called the Commercial Landlords Coronavirus Guide and Action Plan, because that's what's important for us as owners of these properties. So what we always recommend to the owner is first that you do get professional assistance, because when it comes to this topic, you don't know what you don't know. And there are things that you can do and that you definitely should not do that can make a difference in ultimately what the final outcome is. So again, you want to talk to a lawyer who is involved with these specific type of problem. And second step is to evaluate your obligations, resources, and options, because you need to understand what those are in order for you to know what kind of leverage you have when you're dealing with the tenant who's gone dark on you, is not making the payments, whatever. And the third most important step in the process is to get creative with your tenant and your lender. I mean, if you have a lender, your lender may forget, they may not allow you to provide a concession to the tenant. It could be a problem for your loan. And so, but you also do need, assuming that's not going to be the main problem, you do want to get creative with your tenant. Again, if it's a syndication that you have in that particular deal, your first fiduciary obligation is to your investors, not to the tenant. So you want to be mindful of that and make sure that and that could be the reason why you can tell the tenant, look, I'd love to help you, but I can't because I answer to my investors. But also, if there is a way for you to get creative, right now, especially since who knows how close we are to the end when it comes to this, but it might only be another couple months before those tenants may be able to get back up on their feet and help you. Because right now, especially when it comes to offices and retail, but especially offices, if you lose a tenant, who knows how long it'll be before you can replace that tenant, because a lot of people are not going back to their offices. So
absolutely, we're seeing that, and that's a question I'm going to talk to the group about. So, COVID,
Hey,
working
Matthew,
from home, et cetera.
can I cut in for 1 second? Matthew, you there?
Oh, Marty, yes, I can't see you.
Yeah,
but I
yeah.
can hear
So
you.
just real quick, because I was having this conversation with Scott last night. So I'm aware that there's a lot of money available to like landlords and renters, et cetera, and maybe Jeff can talk about this a little bit. But I was told by an inside source in New York City that there's $1 billion plus available for relief, but it comes with strings attached, which is things like you can't get rid of a tenant for 12 to 18 months if you take the money, things like that. Right?
Jeff, can you comment on that?
Can you talk about that?
You're right. It goes beyond. I'm sorry. Can you hear me?
Yes, Dan, I'll come to you in 1 second. Let me just finish with Jeff. Go right ahead, Jeff. Finish.
Yeah, you're correct. And there are a couple other reasons why I would recommend strongly that you don't take that deal, because it's going to really end up being more of a pain than a help for you. So yeah, I think you should just work out the best deal you can, given all the aspects of your unique situation. But yeah, that came out at the beginning of COVID, and I think it was. It's just not good. I'm an owner too, and I looked at it, took a hard look at it. I passed on it. I did not want to be restricted by all of the things that they were going to do to me in terms of that. So,
all right. So Dan, I see you shaking your head.
I just said one of the scariest
you want to
things
jump
in the world
in.
is the
So
government.
yeah, I want to hear from you, Dan. So go right ahead.
I was just laughing because one of the scariest things in the world is the government coming and saying we're here to help, right?
Right.
So exactly.
You said strings attached.
Exactly.
Jesus Christ. That's
right.
Scarier than anything I've ever seen.
So let me talk to you, because I know that you're 70% real estate. I know you're 30% special situations. And when you and I talked earlier in the week, you did this really interesting deal in Nashville, Tennessee, 8 hotels, 1 million square feet, $2.5 billion. Talk about, how does a family office get to you to say, hey, I heard you did this in the past. Tell us about what you're doing in the future. How would a family office actually invest with you that might be listening today? How do we work with you? How do you suggest that?
Well, we have two businesses. One is kind of smaller checks, right? We're 2 to 10 million. And that deal was $100 million check. So I don't know how many family offices can write $100 million checks.
Right.
So there's only a handful. But we've been able, we did a 10,000 lot deal in Austin with the wealthiest real estate family in the country. We did the largest deal in Midtown Atlanta in the last 30 years, a condo high rise. And then that deal in Nashville was the largest in the Southeast. Once you start doing big deals, I think the market starts coming to you and realizing, look, this guy can do complicated big deals. He has entrepreneurial capital.
Go
And,
back to the Austin, Texas. That's really interesting. You had 10,000 lots. To me, that means 10,000 homes can be built. Is that for rent or is that for sale?
That was for, we're still in the early process of entitlements. We made that investment, but that was for a sale.
That was for a sale. So I'm going to ask you to pick up on that, Paula, because I know earlier in your career, you did a lot of work with cell towers and you did a lot of work with office buildings. Did you bifurcate the cell towers from the office buildings, or how did you help your investors make money there? Because look, I'm in Los Angeles, you're in Vegas, and we've got locations around the country. We see these cell towers. Is that something that family office should be thinking about as a dumb asset, but throws off lots of cash flow?
Well, interesting you should say, because there's a specialty fund out of Westchester that's going around reaching out to hotels and office buildings to monetize rooftops right now. And while it's not
Great idea.
The capitalization may not be the greatest, but it's very steady. Once you get a cell tower up on top of your hotel, for example, it's going to stay there pretty much. And they're very creative about, for example, if you wanted to renovate the building, they can move the cell tower. You're not stuck with the same configuration. So I think it's essentially, if you hire a professional like this group, you don't have to worry about it. They'll handle all of the technical work that has to go into engineering, the frequencies and all of that. And you can it isn't just a cell tower, right? You could put emergency on it. There still is radio around. There's a number of different ways to monetize.
And what kind of cash flow could a family office make by investing either in a cell tower fund or having an advisor tell them which cell towers to look at or properties? What's the cash flows look like there?
That, I'm going to hold back on answering that, because we were in flux talking about what the cash flows are. And frankly, it depends on where the real estate is.
Good point. Really good point.
Depends on where the real estate is. Yes.
I like it. I think that's so important. I love that conversation.
Yes.
Yeah, that's true. Dan, talk about that lease. What do you think about that?
We looked at a company in the cell tower space that was the second largest in the space. It depends on who your end lease is, how long your lease is, and what your lease on yield is. It's basically like doing a commercial real estate deal. You eventually end up with a long-term lease and a yield on cost that can be monetized either capital markets or sold in a portfolio.
No, I hear you on that. That's why I wanted to bring it up, because I think it's fascinating. And Scott, for you and I talked earlier today a little bit about, ideas on how to make money in Texas. So, we talked about Austin, Plano, Dallas. IBM came into Austin in 1984. Delta Airlines followed. Google followed. Where do you see the market today for just those three cities? What's taking place?
Well, I'm extremely, I think there's always a bull market somewhere, and I think it's in the triangle of Texas right now, one of them. Obviously, I don't know those of you that heard Ari speak this morning. Ari Rastegari is extremely bullish, extremely confident, and extremely believes that this has substantial legs going forward. Austin, capital city, Dallas, 35 corridor, and Houston, port city, all in that triangle. I think Dan has done a heck of a job, and obviously I'd like to visit with Dan a little later, but they've done a great job at capitalizing the airports, the infrastructure, whether it's trains, there's buses that connect the triangle. The people are moving there. The jobs are moving there. IBM kicked this off 50 years ago in Austin, and it was a little company called Dell Computer in 1984, $1 billion plus investment, Google Fiber 2017, and here we are today.
No, you're absolutely right. And, do you see, is it technology that's driving those three big cities in the triangle, or do you see that it's more of a cold storage, last mile industrial that's driving it?
Matthew, you're a student of the game. You know it. It used to be a one-trick pony, and with the oil and gas, the oil patch, not anymore. I mean, Houston's an international city. You have the Permian Basin, whether we're fully utilizing or not today.
Right.
You have pipelines carrying liquid natural gas down to the Gulf Coast and Louisiana. It has legs. It's well diversified, a low interest rate environment. One could argue a toppy stock market. I think there's a lot of room for growth here.
Yeah, we do too. And I hear it from every investor I talk to. So Jeff, let me come back to you again. You know, how important family offices need an advisor, someone like you that, you know, is always an outsource in there. You know, how do you help them with the legal aspects of buying and maintaining and selling real estate? So those are just three really distinct areas. Do you need a separate lawyer for each, someone that advises on the buying, the maintaining and the selling, or can you usually work with one lawyer that can wear all three hats?
Well, I can't speak for all real estate lawyers. Everybody's got their own special expertise. We certainly help our clients with all aspects of that. As a transactional lawyer, we're involved with our commercial clients in the whole cycle of real estate, because it is a cycle. And so we help them with everything from the initial letter of intent all the way to the ultimate sale, and then trying to figure out how they can comply with 1031 and going for an up leg, or so we help them with everything.
So Dan, talk to me about how the single family offices have changed during COVID. I mean, they're in a capital preservation mode. Are they rapidly investing? Are they going to a first mover position? What's going on in terms of what you're seeing with single family offices, and what should they be thinking about now that we're in COVID?
It depends about the patriarch and how he's made his money. Some people have made money taking a lot of risk. Others haven't. Some are managing generational wealth. So I think everybody's handling it different. We are aligned with the more aggressive liquid families who want to make deals and put money out. Otherwise, we don't really want to waste our time. So we're aligned with people that like to get into hairy situations, have made money, buying distressed assets, understand when people are running out, it's okay to run in. And I think, we're in a bubble right now, across equities, I think crypto, I think some real estate asset classes, because debt's so cheap, and the government's turned the economy into one large casino. And you see everybody just operating like, it's a house money out there.
Yep.
And things don't go up forever. So we're waiting, and we're very excited about what's coming next. We made a small fortune in the last crisis, and you can still buy things cheap and lose all your money, everybody. I just want you to know that.
Is that possible? Thank you.
It happens all the time.
So Paula, let me flip this back to you, because you and I spoke this morning, and we were talking about that single family office and how it's changed during COVID. What are you recommending to those that, let's say, have liquidity, recently just had, say, a realization they have money? What are you telling that family office? Capital preservation or invest?
I think, to Dan's point, it depends on the appetite of the office. I mean, some families, I spoke to one family about a potential investment in a Cupertino hotel, and while they owned a portfolio of hotels, they just decided that they were in capital preservation mode. And they also told me that their ethos was that they only like to do things by themselves, whereas there was a sponsor who wanted them to jump in and get involved. And it was, frankly, it was a beautiful site. It was just up the street from Santana Row, and it could be an excellent hotel, but it depends on people's, people's beliefs and values. And you really have to, we're steering some of the families into some lending products over in London that are secured by London real estate, which it's probably about a 7% to 8% coupon.
Nice.
Very stable. It's a short-term instrument. So it would give you the ability to make that return and yet liquidate, in a short, 18 months or two-year period of time.
So Jeff, let me ask you a question then about, we're still in this uncertainty period. What are the asset classes? What do you like? What do you say in a period of uncertainty? We've got this falling knife happening. Are we catching it, or do you have an asset class in mind?
Well, I guess I'm boring when it comes to this. My preference has always been multifamily. Okay. And I got to tell you that, when COVID started, we were really concerned because of the uncertainty. We just didn't know. And we had a complex, an apartment complex. And at that point, I hired a broker to list it to see what we could get. And I didn't sell it back then because we couldn't get the price that I was looking for. But I will tell you that we, after the vaccine came out in December of last year or January of this year, all of a sudden we started getting all sorts of unsolicited offers, and we ended up selling it in May of this year for 20% higher than the highest offer that was made only back in March of the previous year. So that's just because, you know, if you're too hasty, and I believe me, if I could have sold it for the price I wanted to back in March of 2020, I would have done it just because it was worth it to me. I was actually very lucky that we didn't get the price that we were looking for then, because you know, we would have missed out on that.
Well,
so
Dan,
yeah,
talk to me about that. I mean, are you eager to pull the trigger and create liquidity for you and your investors and your family, or do you think this still has legs and you're hanging in for another 5 to 7 years?
Oh, I think it still has legs, and multifamily is always, as far as I'm concerned, it's always going to be the least risky of all of the types of asset classes that you can invest in, for all the reasons that we know. So
Dan,
yeah.
Dan, let me ask you to pick up on that.
I mean, there's still idiots out there with poor managers. You always find broken deals. The multifamily market is extremely frothy. It's still going to go up though. Depends who you invest with and if they fall in love with these things, because you know, there's still money to be made. But we like to go into broken situations right now. It's very hard to buy anything listed. You're going to be paying way over market. It's hard to really defend anything to your investors. So our investors see us as people that can find off market opportunities. There are people scared. There are retirees trying to get out of deals. There are institutions that have been in deals too long that want to get out. There are broken partnerships who are having problems with other issues. So those are where the opportunities are coming from. The banks still haven't, they've been in extend pretend mode. So there's really, we thought this great crisis was going to come because the underlying economy right now is shit, right? The economy's awful, but the markets are booming. So it's it's all at all-time highs.
Scott, talk about Q4 21. We're coming into it now. I mean, if there's going to be a breakout star for a family office to consider, what would be your number one choice?
Multifamily, vintage multifamily.
Paula, how do you feel about that? What would be your breakout star for Q4?
Well, in the specialty niche of hospitality, we think we're going to see a lot of opportunity coming into Q4, because while lenders did hold off and gave breaks to hoteliers last year, we think that some of that's going to come to an end, but we think that's going to be a buying opportunity. And the other thing I would say, like we think we touched on it this morning, Matthew, but opportunity zone funding is still alive and well with tremendous tax advantages. And in fact, I've been talking to a group out of Connecticut that has an opportunity zone REIT. It's looking for the Carolinas. Incidentally, if there's any deals in the Carolinas, or we're taking a look, take a look at Texas. But they also are in a unique position where they could take a sponsor out. They have a way to structure the early takeout of a sponsor to provide liquidity while still keeping the investors in for the 10-year hold period. So,
ooh, that's a really good point. So Jeff, let me come back to you, because we know that the tax incentives are over in December. What would be, what's next? What's the next big tax incentive that you're hearing out of, you know, say not the Federal Reserve, or maybe the Federal Reserve, but, you know, Congress, that could be there for real estate owners? I mean, if this goes away in December, what's next?
I don't know.
Higher taxes.
Yeah, I wish I did know, but no, I'm just as interested as everybody to find out what is the next big thing when it comes to that. But yeah, I don't.
That's a tough one. And let me come back to you, Scott. You know, malls got mauled this year and last year. What are you seeing for repurposing, you know, whether in your fund where you have $2 million minimums, or just what you're seeing in the Texas area? Malls got mauled. Now what?
So we don't have any malls in our portfolio, and I don't know of any that are in the future plans. However, a great case study is in Austin, Texas. Highland Mall, the old Highland Mall in East Austin, next to I-35. It's been basically was, as you can imagine, went to nothing. And then Austin Community College purchased that, has reinvented it, turned in housing, office space, schools, industrial classes. and it's really done a great job. And I think if you could get a little bit more of that going forward, would certainly be a positive and certainly something to take off of.
Dan, do you think there's an opportunity here to pick up some cheap malls?
Yeah, if you know what to do with it. I see Amazon has an opportunity, stuff like that. I mean, breaking up for self-storage, breaking it up for warehouse. There's guys doing that.
Paula, let me come back to you and let's talk a little bit about assumptions, vacancies, tenants behind in their leases. We've got problems with payments. So now I'm in Q4, Q1 of next year. I'm a family office. I just had a liquidity event. I've got money. I mean, what should I be thinking about in terms of assumptions for either malls or assumptions for retail or assumptions for office? How do I get into it, or should I just neglect those three asset classes?
I think it's going to depend upon where in the country you're looking to place your money.
And it's troubled capital, as we know.
That's right. Yes. I think some of the larger urban situations are pretty risky right now, unless you can really get a very good deal, a very good cap rate on it. We come back to multifamily, self-storage.
Yep.
Those kinds of, maybe they're not very appetizing or sexy, but they're going to work. They're going to be there for the long term. While you investigate, maybe something like a luxury hotel, which could have a generational legacy aspect to it, gives you a good community presence, as an employer in the community.
It's a very good point. I like that community presence, and it's a long-term asset. So let's stay with that. If you had to pick between New York, Chicago, LA, San Francisco, where are you buying that, hotel that maybe we can get a little cheaper today? Which one, where are you going? You're going New York, we're going to Chicago, Los Angeles, San Francisco. Where do you put your money in a hotel today?
Well, I'd probably put it on Miami Beach myself, but
okay.
Ocean resort property, because even during the COVID, many of the resorts still did pretty well because people wanted to get away and they wanted to be outside. So I think some of those opportunities would present potential profitable situations, long-term profitable holds. New York, we're seeing some deals in New York, some beautiful assets actually that had gotten shuttered during the COVID or partially shuttered. And some of the owners are just quietly trying to offload them. So we're working. I mean, we think New York will come back, but the question is going to be when.
All right. Well, I'm going to ask the same question. Yes, it could get worse. We do agree. Right. If we have another Delta variant out there, it gets pretty nasty. So I'm going to ask the same question to the four of you. Do you invite other family offices into your investments, to your investment pools, and talk about what that experience is like? So Dan, I'll ask you to go first.
Yeah, some of the family offices we deal with are like very large institutions. So we've known them for, we've had decades relationships, and some of them put up a couple $100 million a year with us. And then there's smaller investors that are kind of more harder, it feels like, to court. So our business model has always been focus on the bigger families and get larger allocations and make them money. And we've been very successful at that.
And Jeff, tell me what the experience is like working with you. You're a family office, you're a real estate investor. What's an experience like working with you as a family office? If I knock on your door, and I'd love to talk to you. What's that like?
Our family office actually has been in business for 60 plus years. And I can tell you that most of our deals have been done with other family offices in a joint venture, just because not only does it help for that particular deal, but it establishes a relationship that helps us get other deals. Because the hardest part, as far as I'm concerned, the hardest part in this business is finding a good deal. And if I can partner with somebody who's got a focus on that I don't have the time for, or that we just don't have the gift to find, it's great to have those other people. So we're still in that mode. If we still do deals, or happily do deals with partners, but again, the partners have to be good partners, and we are very careful about who we do business with, just for obvious reasons. We just don't want to be in a partner dispute, and we do everything that we can to make sure that we're setting it up correctly from the beginning, as everybody should.
Well said. Paula, how do you invite other family offices in, and tell us about what that experience is like working with you and obviously your sister firm in London?
Well, it's a question of finding groups with similar values and similar investment goals, and then developing, as Jeff rightly said, then developing the relationship with those families, and having some flexibility. I mean, basically, it's like a marriage, right? I mean, you have to be willing to bend a little bit, and you have to know when to step in, and contribute. I saw a very interesting deal down in Miami Beach this past November or so, where the family that owned the Ritz-Carlton, might have been two families owned the Ritz-Carlton, and they joint ventured with the adjacent Sagamore Hotel owners to jointly manage. They're going to jointly manage the two properties, and they're going to share synergies. And I just thought that has the potential for a beautiful relationship.
You're right. And it's funny, we would shy away from the $10 million check only because we've heard that the investor tends to be trouble and hard and calls and, harangues our staff. And the guy that, or woman that puts in $3-4 million and is just a serial investor. We want to take those individuals, obviously, all day long. So I'm going to ask you a question, Scott.
Hey,
how
Matt,
do you deal?
Matt, can I jump in again?
Sure.
Hey, Paula, so after in 2008, you could probably buy, actually, I got a whole portfolio of South Beach, very super expensive hotels for about half price. Is that not the case anymore?
Well, in fact, I had a conversation with a REIT, the general counsel of a REIT last week, for a very well-positioned hotel on South Beach. Actually, maybe it was Mid Beach, but he just said, listen, he said, if you want to pay a two cap rate, we maybe will talk to you, but otherwise we're just going to hold on right now because they're killing it down there. Because of Florida's environment, also of course the weather, they just were able to hold up very well during COVID. So
incredible. Is there any impact on, and I know that it's not your space, but from this building that collapsed, up a couple of miles, is there any impact on property values in that space?
Great question.
Yeah, it's great. Well, interestingly, one of my colleagues at Luxury Hotel Advisors is taking those situations into account when they're evaluating the hotels down there, because a lot of them are older boxes, and it will not just himself, but I mean the regulators are taking it all very, very seriously because of that tragedy. So
I mean, the issue isn't that every building is bad. The issue is that insurance in Florida is already ridiculous, right? So, and it's only going to get worse. I think there's going to be a lot of redlining of those types of buildings.
And you're going to have to put a lot of money into it, right? To redo it, to revamp it, and of course, you always are mindful of the hurricane season.
Gotcha.
Yep. Oh my God, you're absolutely right. Right. It's when's the right time to buy. So let me come back to you, Scott. Let's talk about your backyard. I know that your fund is a multi-state fund, but obviously you're a Texan, and you understand the Texas market. If you had to be a little bit entrepreneurial and go where the mainstream is not going, which two cities do you suggest for multifamilies to be taking a look at?
5-minute Uber ride. Any city across the country, for this conversation, we'll stick on the Sunbelt states, but any city, for example, Austin, Houston, Dallas, Fort Worth, the $5 Uber ride to get to where all the amenities are, you can still find those properties. And I would say, going back to the partnering and finding the right partner, find someone that's strong in that geographic area, that has those contacts, that has a repeatable process, and go source those deals that avenue.
Very well said. So let's start talking about COVID, right? It's the big black swan event out there. It remains problematic for the commercial real estate industry. Commercial real estate, it's a global pandemic. It's just, things have really changed in our world. So I'll start with you, Paul, if that's okay. You're in my upper right-hand screen. How could investing during the highest black swan uncertainty generate big returns? How do we do that?
Well, it's interesting because, and I'm sure the rest of you have seen a number of funds that were put together with the high hope that they would be able to buy at very discounted prices. And at least in the hotel space, for certain of the luxury hotel space, that really hasn't been the case. People are owners are reaching into their pockets to try to hold on and ride it out. Now, that doesn't mean that people don't have their price. Again, to my general counsel there, who said, "Oh, 2 cap will listen to you." But it's not the free-for-all that everybody thought they were going to have as far as getting lower prices.
And Dan, you feel the same way? Do you think, you know, people
Usually
don't see that?
Usually takes 2 years from a crisis when you start seeing the blood coming up in the water. So we're still a little bit ways, 5-6 months.
So
But I
you
think
end of 22, middle of 22, you guys are going to start to take a nibble and maybe put some, you know, feelers out for maybe some purchases to see if you get an answer?
Oh no, we have been putting money out. We put out 100 million over the last 4 months. And what we do is we finance operating partners, and we see deals all over the country, all the time, from people finding the best. So if the guy's bringing you his best deal he sees every year, and you got hundreds of these people, you're going to eventually find a good deal. There's all types of stories of why deals come to you, but there's stress. I mean, there's people having problems in other parts of their life. People get scared. Institutions get scared. So there's quite a bit of opportunity.
And Dan, do you see a lot of deal flow on a weekly basis now versus what you saw, call it, you know, June, July of last year? I mean, is your inbox filling up?
Stopped for a while. Yeah, it's busy. It's busy. We're very busy.
And who's liquidating? Is it the institutions, pension plan, fire and police, or is it the family office? Who's really, or is it could even be a fund or a REIT? Who's actually sort of putting up those properties for sale?
Just mom and pops. Institutions are at the end of their fund life. They have to sell. People like that.
Okay. And I know, Jeff, we talk a lot about multifamily. And I think here in Los Angeles, multifamily has just killed it. They've done so well and they've held up, and, you know, the good properties continue to do really well. Talk about what's going on in your backyard for multifamily and COVID. What are you seeing, and what opportunities to buy too?
Okay, so I'm in the Bay Area, San Francisco,
Yep.
and yeah, it's still going crazy. And everybody is surprised, and we're not sure when it's going to stop. But yeah, I mean, there's still deals available out there, and like Dan was saying, I agree with him that there's always going to be a deal somewhere. And at this point, what we're doing is we are reaching out to all of our relationships in the area and saying, look, we have the money, we're looking for deals. What deal are you working on that you think might be going down because the buyer doesn't have the money, or whatever the reason happens to be? There's always going to be people, and you just don't know why people do why they take the price they do. You have no idea what's going on in their world. And so even no matter if you try to time the market, you can do that to a certain extent, but at the same time, there are good deals in every market. And
so let me interrupt you, and let's talk about a family office. So again, a family office is listening today, thinking about their portfolio and their advisors. And I watched your Stanford Cardinals beat up on our UCLA Bruins over the weekend, and that stadium was filled. So let's talk about college housing. How do you feel about that asset class for a multifamily office who says, hey, we need to diversify a little bit away from multifamily? Is college housing an answer?
Well, yes and no, because initially, right now, there are colleges that are still going virtual, and so but by the time anybody gets something new built, if they're going to build new, by that time, hopefully this is all behind us. But for right now, there are a lot of college housing developments which are very they're not empty, but they are a lot. They don't have the occupancy that they need to have in order to make a profit.
So would you suggest to a family office who knocks on your door and says, I'm interested in college housing, make the investment, hold tight? What are you telling somebody?
I think I love college housing. I think it's a great for me, it's a great asset, just because to be able to have the parents guarantee the rent. I'm serious. I mean, it's a great, but like anything else, it's supply and demand. And so if you're going to be going into college housing in any area, you got to take a look. You can't assume just by looking at it that you know what's going on. You have to go and talk to the housing office, find out what their plans are for new housing. Because, for example, we're looking at something at USC, and because USC, we saw a good opportunity, but when we went and spoke to them, we found out that USC was putting up some major new stuff. Plus, on top of that, USC, their perimeter has gone up significantly. They're building a lot more really nice housing further away from campus. So they're changing the game. So wherever you go, you still have to do your homework.
Scott, changing the game. What are you seeing in the Carolinas for college housing? What's going on there?
I'm probably not the one to ask on student housing in the Carolinas.
How about in Texas? Talk about student housing. You got some of the biggest universities in the world. What's the perimeter look like? As Jeff mentioned, colleges are stepping out and gobbling up more product and putting up better product. How do you feel about existing family offices college housing in the greater Texas area?
Respectively, I really don't have a clue on that one.
That's okay.
Asset allocation.
That's
Matt,
fine.
we
The
gotta wrap
reality
up.
is a lot of families,
I'm
families
sorry.
are going to go
Marty,
into real
say it
estate.
again?
Real estate.
Yeah, Matt, you got about a minute.
A minute. Okay, that's not enough. So here's what we'll do. We got a minute left. So Paula, I'm going to start with you. I'm going to let you go ahead and close. Talk a little bit about, what you think a good family office should be looking at today and diversification. And we'll just go around and Dan, and then we'll go to Jeff and close with Scott. But Paula, since we only have a little time left, talk about where should family offices be looking today?
Well, I'm going to show a bias here with luxury hotel investment is one, because because of the legacy aspect, the revenue will come back. We're pretty confident about it. And it's a generational issue for reputation in the community.
Thank you. Scott, how do you feel about yourself? Tell us where, you would advise a family office today to be putting their dollars.
Family office, go find a strategic partner, go find a JV partner that knows the market in their backyard or what they do best. Wash, rinse, repeat.
Dan, how do you feel about the same question? But, you come at it at such a more sophisticated area because you guys do such big deals. But again, the family office listening today, give them some advice. Tell them what they should be thinking in the next 18, 24 months.
Families think real estate doesn't have risk. You can lose everything you have in real estate. So as Scott said, you got to go with professionals with 30-year track record, interview their investors, interview their track record, what deals they're in, and then line up about 5 or 6 operating partners and let them work for you and negotiate very strong terms. And you can structure deals where even if you lose money, you still don't lose. Even if the property loses money, you still don't lose if you structure it right with the general partner.
So Jeff, I'm going to let you close for all of us. And again, you being the real estate investor's lawyer, tell us again, and the family offices listening, why is it essential for a family office or an institutional portfolio to have someone like you as an advisor?
Just to make sure that, as everybody's been saying, there's a lot of risk. Everybody knows there's a lot of risk in real estate, and it's unnecessary to take risks that you don't have to take. So if you got to have a really good real estate lawyer on your team, a great CPA to help you, guide you, and avoid those disputes and other problems.